What's up, everybody? Welcome to the July 27th, 2026 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by IndiWealth. Today, we're going to get right into those hot button market issues. So let's get started. Let's start with number one here, that tariffs and oil are not helping inflation. So President Trump over the last week has come out with more discussions about adjusting some of the tariffs that are coming off and the new tariffs that they're going to try to install. And you combine that with the U.S.-Iran conflict, then sending oil prices back from, into that normalized range that I've talked about many times, that $60 to $80 range, to then threatening 100 before working its way back down here recently, back into the mid 80s. So again, both of these things tend to be inflationary, not deflationary. They tend to be a way to stagnate economic growth, not stimulate economic growth. We'll see. I mean, can we grow despite these things? Absolutely. There's no question about it, just simply because artificial intelligence is the deployment of that is probably the biggest economic engine at this point right now. And it doesn't rely on either of these a whole heck of a lot unless they start messing with tariffs on semiconductor chips and other components needed for that ecosystem. And I think even President Trump would suggest that that's probably not the best idea. I don't know. You never know where they'll end up in Washington, but from the side that we can see, could we grow through this? Yes. But is this going to create a headwind to growth? I think so. And is this going to create a headwind to getting inflation back to that normalized level that the Fed Reserve, the new chairman, Kev Warsh, came out and said he wanted, that they have zero tolerance for above elevated inflation. Well, that's a new regime difference then, because we've been above 2% inflation for, I think, 65 months straight. So they've certainly had a tolerance for above average inflation. And if he is suggesting that they are going to do things to remedy that, and you have tariffs and oil prices being a headwind to that, interest rate rises could be faster than anticipated. So it's something to pay attention to, something to watch out for. I don't think it's a general, red flag that we have to massively adjust asset allocations as a result of what we're doing here. But we do have to understand that these are not going to help either the things that we want to do, from stimulating growth and stimulating jobs and having those things start to reaccelerate, and secondarily reducing inflation back down to its normalized range. Neither of these are a help, and we'll see how much they hinder as we go forward. Turning to number two, bonds have given you nothing this year. Your protected asset, your income generating asset. From a total return perspective, I saw this on JP Morgan's weekly market recap. Both the U.S. aggregates, corporates are in negative territory this year so far. And I believe munis are as well. I think the only one at a slight positive, I think 1%, was high yield. And the reason for that is that the yield has been higher than the interest rates headwind that they've experienced. So if you look across the landscape in interest rates, 2 years, 10 years, 30-year mortgage or 30-year treasury rates from all those avenues, they're higher than they were at the end of last year. So that is a headwind to bond pricing. As interest rates rise, bond prices fall. As interest rates fall, bond prices rise. It's pretty much math at certain points. But in this instance, we have seen interest rates rising, and so bonds really have not done a lot for portfolios overall this year. Doesn't mean we eschew bonds completely. It does mean that, similar to, I think 2022 I think 2022 taught us the biggest lesson in that bonds aren't, it can reduce volatility overall, but they have their own issues and they have their own problems, and they're not, completely, they are susceptible to interest rate risk. They're susceptible to economic risk. So you have to diversify yourselves into other manners. Bonds giving you nothing this year in a stock market that's up, and other asset classes that are doing okay to relatively well. I don't think that there's a component of we eliminate bonds to do all these other things. I think that the traditional 60-40 of 60% stocks and 40% bonds is probably somewhat incomplete at this point right now. And I think there's a more optimal strategy of using some other alternative assets to generate either income, diversified sources of return, and even diversified sources of protection for your portfolios. So I think it is a worthwhile assessment to take, and that stocks and bonds aren't the only asset classes out there. And there's other things you can do to give yourself more shots on goal to generating some return. Turning to number 3, Alphabet's cash flow. So Alphabet reported last week, Google, and they reported negative free cash flow for the first time since they've gone public, which is pretty crazy. If you've known me, you've known my stance on these companies. I've owned Alphabet for a long time. I'll continue to own it. I think it's a phenomenal company. I think they have a lot of shots on goal that are positive. But one of the positive catalysts of these companies is that they just generated so much cash, right? Is they were cash flow machines. It allowed them to buy companies. It allowed them to invest in growth for their next wave of things that are happening going forward. And now the bet seems to be, especially among these large cap, the quote unquote hyperscalers, that what we can sacrifice some free cash flow here at the interim outset because the deployment of artificial intelligence is so important to our existence going forward that we cannot afford to lose this race. And so we'll spend every dime that we are generating in order to maintain our position there. I get the stance, I get the thought, but it is surprising to see a company of Alphabet stature and for them being so long and being cash flow positive and really being a component of something you can rely on is that, hey, this company just is going to generate cash for us. Not being that way anymore. And Microsoft is probably in the same boat. They're coming up this week. We'll find out what they have to say, but they're probably going to be closer to break even on a cash flow basis. And if they're anything like Alphabet, they're going to guide that spending is actually going up. I did see from Qualcomm, a chipset manufacturer and a chipset owner, if you will, that they're talking about double-digit pricing increases for next year on chips again in 2027. So if the demand for chips is that high and the pricing is that high, I don't know. And the deployment continues to be as necessary to spend as it is right now. I don't know when this cash flow engines that these companies used to have starts to regenerate that as well, because for all of the deployment and all of the pie in the sky mentality around this, we don't have a great solid foundation of what the revenue trajectory looks like over a longer period of time. We all assume it's going to be phenomenal, and I think for a few companies it absolutely will be. But this level of spend requires a return on investment. That's what investors like us want to get from investing in a company, is we want to have return on investment, and a lot of that comes from free cash flow. So if this is going to be materially negative for a long period of time, you have to reassess what the valuation of these companies is over a longer period of time, unless you are totally convinced that the artificial intelligence deployments are in the short term negative free cash flow, but will be a benefit to long-term free cash flow. That's the positive. That's the stance you're taking now if you're buying more into these companies. And from our perspective, I think there is absolute value in owning some of these, but we do have to take a step back and just understand that if this is a trend that happens over a longer period of time, what does it actually mean for us as an investor? So it's something we're paying attention to and we're watching pretty closely as well. On a personal side, number 4, me being old, I've lived through the 90s. 90s was when I was in high school. So it's kind of, I always think high school is kind of your decade, if you will. And the only reason I put this out there is I think 90s was a better decade than it is in temperature. That's a result of us living through a pretty decent heat wave here in Minnesota right now. And my realization that, man, when it hits 90, I do not like being outside. I just don't like it that much. 90 degrees is not my jam. I think it's too hot. I don't like doing things outdoors when it's that warm out there. I would rather do something in the 40s and 50s than do something in the 90s and especially the hundreds. So that's my hot take. I know that's probably not popular opinion, but I'd rather have a light jacket or a hoodie on and doing things outside than having shorts and a t-shirt on and absolutely sweating and feeling like my face is in an oven. So I am coming to the conclusion that the 90s and the hundreds are just not for me. But the 90s, as far as rap groups and all the other stuff that came from that decade, is absolutely my jam. So I would take the decade well over the temperature right now. That's all we have this week. Tune in next week where we'll have our next hot button topics. But until then, thank you very much. Take care of yourself.